Good afternoon, everyone. Welcome to another one of our Wednesday market reviews. My name is Stock Darts, and we're going to do what we normally do on Wednesdays. We're going to go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. Once we go ahead and go through and review the markets, we're going to look at the U.S. dollar, and we're going to look at oil, gold, and silver and see how they're performing. And then we'll move on to chart requests. If anyone on here likes what they see, if you enjoy my analysis of the markets, you can follow me at StockDarts on Twitter. You can find recaps of these on YouTube at StockDarts, or you can visit me at patreon.com/StockDarts, where I post weekly blog content, typically trading ideas, as well as stocks that I'm putting on my watch list and what I'm looking for before I go ahead and enter them. Other than that, let's go ahead and get started. First thing we're going to take a look at is the S&P 500. We're going to look at the ETF SPY. Let's move on to here we go. All right, so we're on the S&P 500 now, and as we can see, we've had a pretty good start to the week. We've had a correction. For those of you that have been here regularly, you'll know that we were anticipating the market to pull back off of its highs that it formed a couple of weeks ago, and it looks like we may be done pulling back already. As you can see, we're already right up to all-time highs on the S&P 500. We'll get to the Nasdaq in a second, but they are past all-time highs, and now the question becomes, where do we move next? So one of the major talking points, or one of the major ideas that I wanted to see when we pulled back, was how the bounce came and how far we were able to sustain the next move up. And honestly, I'm encouraged and a little bit surprised at the strength that we've seen, particularly on the Nasdaq. And what I'm talking about is this, right? So we had a nice move up, and then we pulled back. We tested the 50-period moving average. We bounced a little bit in between the two, and then we bounced right back up. And last week and the week before that, we were discussing this idea that when we pull back, the real key isn't whether we pull back. It was bound to happen. We were getting a little too stretched out, a little too overbought. The real question was, how did the market react once we did pull back? Would we find support immediately and bounce higher? Would we find support and bounce kind of a lukewarm bounce and then roll right back over? Or would we just continue to drift down? And so what we've seen so far is we found support pretty quickly. If you think about it, we really only dropped for 2 days before we found support, but that was pretty quickly shot down, and we came down and we tested a bit lower. However, this next bounce has led us right back to all-time highs and passed it on the Nasdaq. So it looks like we found enough buyers to possibly start moving the market back up. Now, there is a little bit of a disconnect, and while we're seeing the S&P 500 and the Nasdaq perform rather well, the Dow Jones and the Russell 2000 are not quite performing to that standard. And so I still think that it's more likely than not that we are going to continue to trade sideways over the next couple of weeks as we start to get these indices to try to line up a little bit more closely and to have the action follow suit. Typically when we have this kind of selling, and it's not, the correction we've had so far isn't really that massive. I mean, it's been maybe a 3% correction from the highs, so it's nothing too scary or damaging to the market overall. However, it is the first real selling that we've seen this year, and I'm not sure that we're done with it yet. It looks like it on the S&P 500 and the Nasdaq, like I said. But when we get to the other indices, you'll see that there are still some signs of selling. And I think what's going to end up happening is we're going to continue to explore these highs and try to challenge them. But we will find resistance as we have some of the weaker peers or some of the weaker indices try to match that strength and try to reach up to their levels of resistance. And when that happens, I think what we're going to end up seeing is we're going to see the Nasdaq and the S&P 500 come back and maybe test their 20-period moving average again, while the other indices really battle with some higher resistance levels that they haven't been able to overcome. And I think really what I'm expecting right now, to get a little ahead of ourselves here, is something like this. All right, let's change these trend lines back to solid. So we had so just to recap, right? We had our first real correction of the year, and then we're in the process of bouncing off of that, right? And so the expectation right now for me is not that we continue upwards and just continue this rally that we've had since last November. I think what we're going to see is maybe we push up towards new highs, but I think that we're still going to be in the process of trading sideways for a little bit longer until we get enough new buyers to step in and to alleviate this overbought condition. So what I'm seeing here is we have this wedge, right? And typically when you have these types of rising wedges, you have weaker and weaker hands that keep jumping in and following the price action and chasing the price action higher. And eventually what happens is you have too many traders that don't really believe in the market holding on to highs, and that's when you get these sharp corrections. And what happens is when you get these sharp corrections, you get the smarter money that's waiting for value to come in and step in and buy. And I don't know that we've gotten enough of the value buyers to come in to support enough, to have enough demand to push through the supply that's at these levels. And so I think that what's going to happen here is we're probably going to need to spend a little bit more time and find more buyers, find more value before we're really ready to go ahead and rally as strongly as we had to start the year. Now, the good thing is that so far we haven't shown any real signs of rolling over and heading lower on the indices. The only index, of course, as usual, is the small caps, which we'll get to towards the end of the market review, and we'll see where they stand. But as far as the S&P 500 and the NASDAQ in particular concerned, we're actually seeing very nice signs of strength as we are already kind of going past the 20-pair moving average and making our way back up towards higher levels of resistance and actually trying to push through them. However, like I said, just judging by what we'll see with the analysis of the four indices when we look at them as an aggregate, I think that what we're seeing is a market that needs to spend a little bit more time trading sideways. But of course that's theory, but I think that's the more likely scenario. However, we're going to go ahead and analyze the market and see what potential scenarios are possible, and that way we'll have a game plan. We'll have a game plan ready to go depending on what the market does. All right, so let's take a look at the key levels here and try to really understand what's going on with the S&P 500. So as we can see, of course, we're at a key resistance level, the only key resistance level there really is right now since we're at all-time highs, which is right here around 332, 333, and the market looks like it wants to push past it. We are forming a hammer candle up here, which is not really a bullish sign. Typically people just associate hammers as bullish candles, but that's really only the case on corrections and at support. When you're finding hammer candles up here at resistance levels, that's usually a sign of selling starting to come in, rather than buyers stepping in to support price action. So we'll see how this develops. I mean, obviously we still have a whole half a day to go, so this might finish as a stronger candle with more of a green body and new all-time highs, or it might end up being a gap and then we have a red close as it closes towards the lows. So I think that'll give us a good inclination or a good picture of what we can expect as we move into Thursday and Friday. But for now, we'll just analyze it as it is, and really it's a market sitting up at resistance and looking like it wants to push into new highs. Now, as far as support levels are concerned, well, we now have a pretty strong support level. It was a level that we outlined a couple of weeks ago. We expected to support the price action, and that is this area around 320. As you can see, we kind of came down. We did the whole 2050 dance, which I've explained in detail before. A lot of times when you have a stock that's trending strongly, whether it's the markets or whether it's an individual stock, you'll have the 20 period, which is this brown moving average, and the 50 period, which is the green one. They start to trade and they start to climb up in a kind of a parallel manner, almost like train tracks. And usually when you have a strongly trending stock, those train tracks will do a good job of supporting the price action. What happens is typically the first pullback will only come up to about the 20 period moving average, and then you'll have the 50 period supported underneath as sort of the bottom train track. Give me a second, someone just rang my doorbell. Alright, sorry about that. That was just a package delivery. Alright, so as I was saying, you have the train tracks, right? And what happens is when you come back and test the 50, particularly when you have a market that's starting to get a little stretched out, you'll have this dance where the stock comes down and tests the 50, and then it kind of chops back and forth between the 20 and the 50. This is perfectly normal. Part of it is just mathematical function of the moving averages catching up to price. And Usually, when you have a strong trend like this, you'll end up resolving to the upside. You'll of course continue the trend, and you'll start to make your way back over the 20, and that's what we're seeing right now. Now the question becomes: are we going to continue trending and continue kind of climbing at the same slope? If that's the case, then we may come down and just test the 20 and then start to break through it, or we might just blast right above these highs and then continue climbing upwards. And I think overall, what we're seeing right now is actually very healthy signs of a strong rally, and I don't think that, despite the fact that we've had some selling pressure, I don't think that any of the kind of the fear mongering that we're seeing on the TV is warranted. I think that we're still in a market that's very strong, and we're in a market that I think deserves our trust as far as looking at it to trade to the long side and buying names and holding names. There's really not any signs telling me that we need to worry and rein in risk and be careful. Even the last couple of weeks when I was anticipating a drop in the market, I was explaining pretty clearly that it's not a drop that I'm thinking about shorting. It's more along the lines of waiting to see when we can buy the dip again and when we could start getting right back into this rally and taking advantage of this action as it continues to climb upwards. And so I think that we're still in that scenario or that environment. We're in a strong market that's going to climb higher. And while in the short term I think we might trade sideways a bit, I still think that we're in a market where we need to focus on trading to the long side. We need to buy stocks when they hit value or when they're emerging from consolidation ranges. And really the only concern is to be disciplined and to make sure that we don't start to make mistakes because this idea of this fear of missing out on a stock as it goes upwards. A perfect example, of course, is something like Tesla, which has had an insane squeeze as it continues to ramp upwards, and we finally starting to see some red candles on it today. But I think that this is the perfect example of exactly what happens when traders start to get fearful of missing out. They start to just chase the price action upwards and upwards, and you get all these short sellers that keep jumping in thinking, well, the stock is too strong, it's time to short it. And this is exactly why I think it's a bad idea to try to short stocks in this environment. A lot of traders have been looking at Tesla as a short since the 200 or 300s because they think it's too high. They think it's overpriced, and they're not looking at it from a technical perspective and trying to take advantage of what the trend is and what the prevailing direction is. And what ends up happening is the only thought they have is, well, the stock is too high, it doesn't deserve to be up here, I'm going to short it. And what happens, there's so many traders that are fearful of missing out on this strong move that anytime you have a red candle, they jump in immediately and propel it even higher upwards. And it just continues to climb, and then when those short traders stop out because they're in too early, it just fuels the momentum more to the upside. And so we're not seeing exactly that in the markets overall, but that's the reason why I tend to stay away from trying to short a market that's as strong as it is right now, and why you want to make sure that you remain disciplined and you don't try to break any of your normal rules because you're fearful of missing a move or fearful of trying to basically missing a move and thinking that you're not going to get another chance at a stock or another chance at a particular type of trend. So what we want to do again is remain disciplined, not let this market lull us into complacency and lull us into thinking that it's going to erase all our mistakes and continue climbing upwards whether we chase the action or not. There is room for pullbacks as we've just seen, and a lot of traders could get into trouble even on these minor pullbacks because they start to think that they don't need to stop out because the market is just going to continue climbing as it has in the last the past 2-3 months or whatever it is. All right, so we have our key resistance and we have our key support levels. I think at the moment we don't need to concern ourselves with any other levels of support. Anything down here around 315 or 305, 308, that's not in the picture right now. We found that we've gotten our bounce, and now the question becomes, if we do fall back again, do we fall short of 320, which I suspect will likely happen. And more likely than not, what's going to happen is when we find resistance again, whether it's today or tomorrow or Friday, we're probably going to come back and test the 20-pair moving average and maybe dip a little bit below it. But I think as long as we hold above the 50 and don't test the 50, that we're probably going to continue climbing upwards and continue trying to do that pattern that I mentioned where we kind of come back, we test the highs, we pull back, but not quite as low as our recent pullback, and then we come up and we test the highs again, and then again if we do pull back, it's an even more shallow pullback as we develop one of these triangles as we start to try to break out. And if that's the case, then that should work out pretty well for us. Now, if you're not sure, If you're a little bit worried, well, what are the signs that we are not in that sort of trend? Well, the first thing we'll see is when we pull back, not only will we go through the 20, we'll make our way right back to the 50. And if we make our way right back to the 50, then you can be pretty safe in assuming there's more supply than there are buyers at the moment. And the more likely scenario than not is that if we do come back and test the 50s, we're probably going to come through it and test this 320 area. And that will be your level of support. I still think even if we come all the way back down to 320, that it's a buying opportunity, and that will be a good level of support to go ahead and buy the dip. But at that point, we will need to be patient and wait to make sure that buyers step in, because of course at that point we will have sliced through our moving averages twice, and that will go a long way towards invalidating this nicely sloping upwards train tracks that I mentioned earlier with the moving averages. And it would definitely mean that the market is going to trade more sideways and probably for a little bit more prolonged time than I'm anticipating at the moment. I think at the moment, I'm thinking maybe we need to trade sideways for another week or two and then try to continue rallying. But if we breach the 50 again, we may need to trade sideways for a month or two rather than a week or two. And if that's the case, then we'll go ahead and reevaluate. That's why we meet every Wednesday, and we'll try to judge from there what the next step is and what we should be doing as far as trading this market. But I think right now, more than anything, what I really want to stress is that we shouldn't be worried about selling pressure, or about a bear market, or about a market that's topping out. I think that we're in a very strong market, and we should be looking at these opportunities to go long when we get them. Now, over the last 2 or 3 weeks, I've been focused a lot more on earnings trades as the market has tried to find and support and stabilize. And it's done well for me, and I haven't had to worry too much about trading to the long side or trying to get in early for a bounce play. And I've been able to let this kind of develop without having to stress out or really dig deep for trades and trying to manufacture trading opportunities, because the earnings trades have worked out well for me and I haven't had to worry about it. But as we've kind of gone through most of the meat of earnings season now, I'll definitely have to start looking for more swing trades. And so hopefully what we've gotten here is a nice reset, and we'll have a lot more stocks that have consolidated over the last couple of weeks and will give us good buying opportunities as they start to emerge from these bottoming patterns and these short-term corrections that we've seen. And if that's the case, then again, like I said, we should be able to take advantage. Even if the market starts to trade sideways for the next week or two, we could still see individual names that are maybe a little bit behind or a little bit ahead of the curve that provide us with long trading opportunities. And that's what happens a lot of times in these bull markets. When the market starts to meander sideways, that still gives you good trading opportunities as long as you find the right sectors where the money's rotating. All right, now let's take a quick look at the NASDAQ. And as we can see, there's been a little bit more relative strength on the Qs. However, you can see that there is selling pressure today. Despite the fact that we made new all-time highs, we gapped up significantly, but we are pulling back off of that, and that's to be expected. I think the NASDAQ's getting a little bit ahead of itself again, and as you can see, it's really struggling to hold these highs. But overall, it's still a bullish pattern. And I think again, this is more indicative of a market that maybe needs to come back and test the 20 period and chop a little bit more before it's ready to really rally in the manner that it has since last November. But overall, it's still very strong, and there's not a lot that can be said that's that negative. We had the rising wedge. We had the correction off of it. We only hit the 20. We didn't come back and test the 50 on the NASDAQ. So again, shows a lot of relative strength here. And then we had the nice, almost like a trampoline bounce off the 20 back to new highs. Now again, if you take a look and you just analyze the upper edges of this wedge and actually really the trend that we've had for a while now, you'll see that we're kind of reaching the top of that trajectory, and more likely than not we need to come back and slow down. But what we're seeing here now is that we can actually turn this wedge, we can look at it maybe as a channel. I'm not sure that the bottom of the channel is clearly defined where we can actually say what it is, but you can see that the markets, especially the tech names, are still trading in a very nice trajectory, even with the little correction that we had. I'm not going to keep that trend line for now. I still think that we need more support before we find the bottom of that trend line, of that channel. But you can see that the market's still sloping strongly, and even if we do sell off of the top of this channel, there is plenty of room to pull back and still have the market trading in a nice rally, and not even be trading sideways as far as the intermediate to long term is concerned. So I think again overall, if you really want to look at it and figure out where we are, the market's still in a very strong upwards trajectory. It's still in a strong rally, particularly the NASDAQ. And of course, a function of that is the fact that all the FANG stocks are finally performing better. Towards the end of last year, a lot of the FANG stocks were starting to take some hits. If you take a look at what happened in September, October of last year, Facebook and Amazon, a couple of them were actually struggling, and you can see we came down and tested a 200-pair moving average. But since then, Facebook has gotten its act together. It did do poorly after its earnings, and it's starting to bounce again, but it's still holding up pretty well. But when we look at the rest of them as an aggregate, you can see Amazon, again, towards the end of last year, it actually fell below its 200-pair moving average, but had a very strong earnings and was able to push it back towards new highs. Apple, as well, has been very strong even throughout the course of last year. Netflix has made its way back up even after having kind of a mediocre earnings. And then Google, which reported on Monday, is also doing well as it holds up close to all-time highs. And so now that we got all the FANG stocks back together and moving strongly, as opposed to towards the middle of last year where they were all right around their 200-pair moving averages, that's a good reason as to why the tech names and why the Qs in particular are trading near new all-time highs, and why tech as a sector is a good place to be in right now if you're trying to rotate and trying to chase where the money's going. Look at tech names because they're the ones that are outperforming, particularly after the earnings reports. You don't want to go ahead and try to buy them prior to earnings. You might get lucky and it trades in your direction, but you might be unlucky and you get a 10 or 20% gap in the wrong direction. So you still want to be patient. You still want to be disciplined about what you're trying to buy. But this is a good area to look at if you're trying to figure out where the money's flowing and what is outperforming the markets in general. Now, as far as the key technical levels we want to watch, there's really nothing resistance-wise that we could really hang our hat on and say is a major level of resistance. We have this theoretical resistance as far as the top of the channel is concerned, but that's not really anything to write home about. But as far as support is concerned, we do have some nice levels of support developing now. Typically when you have, again, these train tracks, the first level of support you need to really concern yourself with is the moving averages. And as you can see, we've got plenty of room to come back and test the 20. However, horizontal levels of support that we can look at, our major level now, of course, is going to be right around 218, at least as far as short term is concerned. We have a lot more strong levels further down below, but I don't think we need to concern ourselves with these levels because at the moment, with the strength of the market, I don't anticipate us even losing this 218 area. And if we lose 218, then we can start looking downwards at what else is up there. But for now, we could just focus on this gap between about 224 and 222, which more likely than not will be the 20-pair moving average if price comes back down to meet it. And that should act as a pretty strong level of support considering the relative strength of the NASDAQ. And if we lose that level, then I think we can maybe come back and take a look at 218. And I don't anticipate us losing 218. I will say this: if we do come down and test 218, more likely than not, the price action is going to wait for the 50 period to come up and meet it. At which point we will use the 50 period as a support level to go ahead and maybe try to bounce off of that. But again, I would only anticipate a drop up to that level if the market starts to trade definitely more pronounced sideways, and that's that scenario I was mentioning earlier, where instead of 1 or 2 weeks of sideways, we're going to get 1 or 2 months of sideways. I think at the moment, if we pull back and lose the 20, then again, that's probably a sign that we need more time to trade sideways. But more likely than not, what's going to happen is we're going to come up and hit the 20 and try to bounce again, and then from there we'll see what the next bounce does. But I think overall, again, judging by what I'm seeing here, it looks like we need to trade sideways here. It looks like we had a strong bounce and we caught a lot of shorts off guard that thought that we were going to correct more prolonged and head lower. And that's part of the reason why we've had such a sharp bounce over the last couple of days, is catching some shorts off guard that we're hoping for more selling pressure than what we've seen so far. However, I still think there's a lot of supply up here, and I don't know that we have enough buyers to really sustain the price action upwards at least over the next week or so. So again, I'm anticipating that the market slows down here and that we trade sideways and consolidate and build at the very least a bull flag as we wait for more buyers to step in and we see more of these people that caught this nice bounce take some profits. There's really not much else I want to mention with the NASDAQ. Like I said, it's the strongest of the 4 indices right now, and it's the one that I anticipate to fall back the least if we do continue to correct as we did over the last couple of weeks. Now, looking at the Dow Jones, there is a little bit of relative weakness here compared to the other two. It is close to its all-time highs, so more along the lines of what we're seeing out of the S&P 500, where we had the nice bounce, we had the dance between the 50 and the 20, right? So we came down, we hit the 50, we bounced up, we came down, we tested the 50, we actually overshot it, but we came back through, and we're right back on the other side, which again is typically a trend continuation move. When you have this move like this, where you come and tested the moving averages, once you have that conclude, that's usually a trend continuation telling you that we're ready to continue climbing upwards. But like I said, I think that even though I think in the intermediate term this is a trend continuation move, I think in the short term we still have a lot of resistance we need to contend with, and I think that we're going to come up and try to test this and test new highs and probably stall out as we wait for the more buyers to come in, and we have the buyers that took advantage of this quick drop take profits, and you know, hand the baton off to traders that are willing to accept value up here and try to push the market past it. I think we probably need one more test of the 20, one more pullback before we're really ready to go ahead and try to breach these highs, at least as far as the weaker indices are concerned. So for now, I'm anticipating pretty stiff resistance up here around 293, 294, and I don't think that we're really ready to push through them. Now, I could be wrong, of course, and the market could just barrel right through there, but my thinking is that we need to spend a little more time trying to push through that. So I'm anticipating a pullback again, and from there we'll see if it's a shallow pullback, if we have enough buyers to step through and push it back through. Now, key support levels I think are pretty obvious here again. We've got very strong support here around 283 to 282 now. The moving averages again should act as support, but not quite as strongly as the NASDAQ. I think as you've seen, the Dow Jones has violated those moving averages pretty quickly, again showing a little bit of relative weakness. And more than anything, I'm expecting this 283 to be the level that supports price action if we do pull back again. But I think as long as we hold above that, we're fine, and it just means that we're trading sideways. Now, if we breach that level, the same as if we breach these levels on the S&P 500 and the NASDAQ, then that's more worrying. And at that point, we'd have to reevaluate where we stand in the market, and whether we're in line for an even stronger correction that maybe even heads back down towards the highs of the last couple of years. And we haven't looked at the weekly charts yet on any of these. I'll go ahead and look at them real quick now, and just give you guys a better idea of why I think that we're in such a strong rally or strong buying environment, and why I'm not really concerned right now, even if we are starting to see a little bit of selling pressure in the markets. If you take a look at the S&P 500, you see the range that we spent the last couple of years in. You can see that towards the end of last year, we really started to build up steam and break out of that range, and then finally we're able to just bust out in November and December as we got our little Christmas rally, and we're really off to the races right now. And as often happens in these types of environments, these rallies can last for a while, and I'm anticipating that we can continue to rally for a few months now. Not necessarily that we've already seen the extent of what we can rally. I think that there's enough of a move here where we can see this rally sustain itself for several months. Now, it's not 100% certain. Of course, nothing is, but when we get to IWM, it'll be really the biggest chink in the armor as to why maybe we're not going to rally like we did in 2017. But at the moment, we're really seeing a rally that could be the same as what we saw in 2017 or what we saw even prior to that in 2014, 2015. And you can see on the NASDAQ, it's the same picture. We have a market that's really starting to accelerate and leaving behind a strong base. And that's why even if we do pull back more substantially, we're still in the midst of a very big long-term breakout. And we have a lot of room to pull back and still be in just a retracement of this breakout. So overall, we're just in the midst of a very nice, strong move out of the market. And there's a lot of room for us to chop or even pull back and still have broken out from the range that we spent the last couple of years in. So overall, it's just a good place to be if you're a buyer. If you're someone that wants to short sell, and then you're probably struggling right now, and my advice to you is to just not bother with that unless you're a day trader. Now, obviously, if you're a day trader, then shorting is a viable strategy. Every stock is going to go up and down, and you can't put on blinders and expect everything to go up every day if you're a day trader. But if you're a swing trader, then even if you're anticipating a drop as I was or we were over the last couple of weeks, you're better off waiting for that drop to occur and buying the dip off of that and take advantage of the overall upwards current that the market has right now. And it's not like I'm a permabull that can't short. I've shorted during many different times in the market, but I think the environment right now is not at all suitable for shorting. And I think that we're really better off just trading to the long side and take advantage of this momentum. Now, that being said, if you're looking for weakness in the market, I think IWM has been the key place. However, that being said, we have seen some nice strength over the last 2 or 3 days, and we've seen a very aggressive bounce to get back towards its recent highs. And overall, at least it's right back above it. But as you can see, IWM, unlike the other three indices, actually did sliced through a lot of support levels. And our nice support level that we've kind of banked on for the other three indices and has held didn't really hold for IWM. You can see this relative level here, which is the area that we pulled back towards the end of last year. We actually breached it pretty quickly. We sliced through the 50-period moving average, and while we've come back and reclaimed the 50 and the 20, overall IWM again is the weakest of the four indices, and is I think the one concerning problem we have as far as looking for a strong rally like we saw in 2017 or even prior to that, and that is typically the small caps are more volatile, and they tend to be where traders go when they're being aggressive, and when they're being really just ignoring any kind of risk, and they just want to go ahead and take advantage, look for as much reward as possible, and take advantage and look for as much volatility as possible. IWM is where you're supposed to be, but that's not what we've seen. Instead, what we've seen is anytime that there's any kind of a sign of correction or selling in the market, the first place traders get out of is the small caps. So it shows that traders are still a little bit fearful of this market and aren't really 100% behind this idea of a rally. And because of that, we've kind of slowed down a little bit. Now, that being said, the markets, as we can see on the weekly, you saw the other three already, but here's a look at IWM. And even though IWM is still basically trading sideways, the rest of the markets have all rallied pretty well. So, despite the fact that IWM continues to struggle, it doesn't mean that we can't see a rally across the other three indices. However, what I'd really like to see is IWM make that final push to get back to 173 and to new all-time highs. And I think once we can get IWM up there, then I think we could get an even stronger rally out of the other three indices than what we're seeing right now. And if that's the case, then I think we could see a rally that sustains itself for several months rather than the 1 or 2 months that we've seen so far. So I think overall this is one of the areas we want to watch to give us a clue as to what the buyers or sellers are doing. If we're going to see selling pressure come in the markets, the first place we're going to see it is IWM. So if you're worried about the market and you think that we're going to find more selling pressure, well, keep an eye on what the small caps do. If they lose this level around 163 again, then that's a warning signal that the other indices are likely going to head back down and test critical support. If IWM holds above 163 and finds support and starts to bounce again, then you could be pretty safe in assuming the other indices are going to be already bouncing prior to that and finding probably support at the moving averages rather than horizontal levels of support. If IWM makes its way back to highs, then I think that's more likely than not going to come at the same time as the other indices all breaking out and really extending past their highs. If you're really worried, this is a place to watch. If you're pretty bullish, then you want to be looking at the NASDAQ and you want to see how it behaves and whether it can pull the other three indices upwards with it. I think overall, if you look at them as an aggregate, more than anything, it shows that we still have some resistance to push through on IWM and on the Dow Jones. And I think that that's going to lead to the other two indices stalling out and waiting for them to kind of push through. And if we do pull back, as long as we don't slice through the levels that we've just kind of established as support, I think that we're okay and that we're ready to continue trying to rally maybe over the next couple of weeks. And maybe into the middle to end of February, we'll start to push through highs and start to push past it. Now, this could happen faster, it could happen more slowly, but I think in general what I'm expecting right now is a market to stall out for a little bit of time and then try to push through those highs. And if it doesn't push through those highs, then maybe we turn right back around and come back and head towards our levels of support that are just underneath the price action. But I think that the most likely scenario is that we just trade sideways for a bit and then try to push upwards. The next more likely scenario is that we try to push upwards, fail, and then come back and test support and trade sideways. And I think the least likely scenario right now for anyone that's worried about the market is that we violate these support levels. I think that's as far as the three goes, going up, sideways, or down. I think down is by far the least likely scenario as far as we need to be concerned. And so, more than anything, we should again anticipate if we do drop to just figure out where the support level is and try to go ahead and take advantage of that value while you can. And if we do lose key support levels, then we could go ahead and reevaluate and figure out where we want to go next. Because even if we do lose those levels, in the long term, we're still in a very strong bull market, and it just means that we need more time to kind of correct. And there will be, if you're worried, every market, of course, has a top, and if you're worried that this might be it, even though I don't think it is, there's always a lot of warning signals, and losing this level of support would be the first warning signal, but then we'll have another warning signal and then another one before you really have to worry about a full-out bear market. So there will be a lot of different signs telling you to be worried if we need to be worried. But I think at the moment, that's not where we stand. I think we need to just take advantage of this and, like I said, just trade to the long side when you get good opportunities and make sure you're not wasting them because, these kinds of markets don't last forever. And you want to go ahead and take advantage of them and use them as best you can because, we've just spent 2 years trading in a market that was trading sideways that wasn't really the easiest market to trade. There have been more difficult markets, but the last couple of years really wasn't that easy for a lot of traders, and a lot of traders struggled. And when we have markets that are climbing, like we've seen right now, especially when you look at something like the Qs, when you have this kind of price action, you want to take advantage of it as long as you can because there are times when you get this kind of stuff, and it's not quite as easy to trade. And this really puts traders into a lot of trouble. So what you want is when you have this, take advantage of it and make sure that you're not second-guessing yourself or second-guessing the market while it's giving you this type of a gift. Okay? All right, so that's the markets. If anyone has any questions regarding that, you can type it in and I'll go ahead and answer them. We're going to look at the U.S. dollar real quick, and we're going to see what gold and silver are doing in oil. And then we'll move on to chart requests. Those of you that are in here, if you have a chart that you want me to look at, let me know. It could be a stock that you're in. It could be one that you're looking to buy or one that you're looking to sell. Or it could be just a stock that maybe you have a question on, a pattern on. Whatever it is, type it into the chat, and I'd love to go ahead and take a look at it and give you my take on it. Let's start with the UUP index, which is the U.S. dollar as an aggregate. As you can see, we anticipated a bit of a pullback on the U.S. dollar last week, and we got that. But we also got a quick bounce right back to the 200-period moving average. And the dollar's showing a little bit of resiliency as it's trying to make its way back up and fill this gap. I don't think it's ready to fill that gap. I think that we're probably going to see some selling pressure yet again at the 200-period moving average. But overall, I think the dollar has shown a good sign of stabilizing and trading sideways after this really swift drop that it had to close out the year. Now, if we look at the U.S. dollar versus the euro, and again, this is the euro USD cross, so we're going to look at in terms of euros, up is good for the euro and down is good for the US dollar in this particular case. So it's going to be inverse to the UUP index. And as you can see, again, the euro had a nice bounce versus the dollar, but the dollar has had a nice resurgence against the euro. The euro is still attempting to really bottom out here. If you look at it on the weekly chart, you can see what's happening here. It's really struggled versus the US dollar for a while now, and I think it's establishing a bottom here. Personally, I thought it had already established it, but it's starting to really come back and make me second guess this idea. But it hasn't rolled over yet and headed lower. But it's in the process of really just trying to establish a base and trying to turn this downward trend into a neutral trend. More often than not, what happens is you don't always get this straight up, bullish to bearish downtrend. A lot of times what you get is you're going to get a downtrend that turns to neutral and then eventually turns to bullish, or neutral to back to down. And I think in this case we're basically shifting from downwards to neutral. And it's really now whether it's going to kind of come right back up and try to make its way upwards. I know a lot of you guys don't trade Forex, but this gives me a better idea. When I see what the US dollar is doing versus the rest of the world, it gives me a better idea of what I can expect out of our markets, and it also gives me a better idea of what I can expect out of commodities, which is why I look at it. I also do like to trade Forex. I think a lot of times this gives us cleaner moves than we see on stocks, but it's not for everybody. But as far as I'm concerned, if we have a chart on it, then it's an instrument I can trade. And so what we're seeing right now again is the euro attempting to stabilize, and if it will do that, then it's going to find support here right around 110, 109.9. And while we're not seeing it now, we'll see if it can find it. It can give us some reversal candles up here. If it doesn't, then it's going to head right back down here and start testing the lower 109 area, and that would bode well for the U.S. dollar. Now, if we look at the U.S. versus the Canadian, you can see that the U.S. dollar has actually ramped up pretty strongly versus the Canadian. It's coming up into some pretty stiff resistance. I expect this resistance to hold, and I expect the U.S. dollar to pull back, partly because I expect oil to start to do a little bit better. But we'll get into that in a second. Overall, it's done a very nice job of climbing and staving off what looked like a rollover and some really a serious chink in the U.S. dollar's armor. If the U.S. dollar would have rolled over versus the Canadian, that would have been some trouble for U.S. bulls. But it kind of made its way back up, and I think it's starting to approach resistance. And so this is another chart lending to the idea that the U.S. dollar might stall out here and start to head right back south. And if we look at the U.S. versus the yen, this one's a little bit different. I think, again, more a function of yen weakness than U.S. dollar strength. But the U.S. dollar, again, stabilized and bounced up. And it continues this broadening wedge, which is not really the greatest pattern you want to see. Now, it did do what we were thinking last week, which is, and for these broadening wedges, what you want to see is you eventually want to see the volatility contract, right? So we want to see something like this. And then if that's the case, then you can build up some consolidation, and then you can have the next move kind of either go through or reverse right back down. So what we're seeing right now, again, is we had a very nice bottom, and then we had the breakout, but that breakout has gotten really sloppy. And there's been a lot of growing disagreement as to what the U.S. should do versus the yen. And what we want to see right now is we want to see that narrow, and then eventually you get an imbalance and you'll get a break in one way or the other. That might not be what happens. Maybe this continues to get more volatile. If that's the case, then it'll come right back up to 110. So I wouldn't consider this as a trend line to trade, although this bottom one can hopefully hold and give us a better idea of what the next move is as far as the U.S. yen is concerned. But I think overall, what we're seeing here is a U.S. dollar that has found some short-term strength, but it's heading into resistance areas or potential resistance areas. And if that's the case, it should give gold and silver a little bit of relief to bounce. As you can see, gold did pull back and has come right back to support and is trying to hold here. Silver has stalled out for a while now at support and is at doing that 50 to 20 dance, but it doesn't have quite the strong trend to trust this as a continuation move. And instead, really, what it's trying to do is we had this downtrend and we had the breakout, and it's just trying to confirm that this breakout is legitimate. This should be good support. If we lose that support level, then that invalidates this entire breakout. So there are going to be a lot of bulls trying to support down here around the 1620 area. And it's going to be a similar picture with GLD, just with more strength. As you can see, GLD, that support, the breakout hasn't really been tested. And the support is holding much higher up, actually closer to its previous highs. And I think, again, the bulls are looking to sort of defend this level. And I think that these might be worth trading to the long side if we see another candle here showing support, particularly if we see the U.S. dollar hit into those resistance levels we're looking at and pull back. If that's the case, then we should expect gold and silver to make their way back up towards the top of their short-term ranges. And then finally, the last commodity we'll look at is oil. And oil has really, really cratered. A lot of this possibly due to what I was seeing earlier was maybe some energy slowdown in China because a lot less travel going on right now. There's probably more going on behind the scenes than that, but it's ugly right now. It finally has a green candle today. I think this is due for a bounce, if anything, just at a snapback bounce because it's so oversold right now. It found support around the $50 range, and I think if it does bounce, it's probably going to find some stiff resistance just around 55 or a little bit below there. But there's probably room for at least a bounce for another day or two. This is another area of weakness. If you're looking at trading, oil names are pretty weak, but they're very depressed right now and very oversold, and could be ready for a couple of quick bounces. But they're not the kind of bounces I'm not interested in because, again, this is kind of the opposite of what I was saying before about not wanting to short the market. I think that right now there are plenty of other areas that are giving us better bounce opportunities to try to force a trade on this, just because it's so oversold. Now, oil as a commodity, I think, is due for another bounce, at least to sustain this bounce for another couple of days. But when you have this kind of a big turnaround, I think it's a big trend shift. And more likely than not, it's going to continue to find resistance rather than support as it tries to move forward here. You look at it on the long-term chart, and you see what it's doing. You can see this is a pretty nice support level around 50, but we actually did breach below it. And while there is the potential for it to make its way back up into the 60s and continue trading sideways, I think what we've seen here is we've seen very strong selling 3 times, right? We had a nice bounce and then very strong selling, a nice bounce with kind of intermediate selling, but then really strong selling again and really strong selling again. And I think that this is showing the oil is not really ready to sustain prices above 55 to 60. So more likely than not, the next bounce is going to come up short of that $60 to 62 range, and we'll then come back down and head south, and then from there we'll see whether there's enough support to continue sustaining it. But what I'm seeing is you could tell oil, there's a lot of sellers and there's a lot of supply here in the $60 range, and oil's just not really ready to push through that. Now, that being said, I think there is enough support here at the $50 range that we don't have to think about it in the 40s yet. But we'll see what happens when it bounces next. But I'm not expecting that strong of a bounce at the moment. I'm expecting more than anything one of these, kind of like a dead cat bounce, or just a reactionary bounce as things have gotten a little overbought, a little oversold and a little bit stretched out to the downside. So that's oil, gold, and silver. And for the most part, the markets, like I said, if anyone has any questions regarding any of this analysis, feel free to ask. Like I said before in the intro, if you like what you see here, you can always follow me just at StockDarts on Twitter. You can visit me at patreon.com/StockDarts, where I post trade ideas every week. And if you like this analysis, I'm here every Wednesday as well. So hit the follow button or subscribe or whatever they have here, and you'll get notified whenever I stream. But I basically stream every Wednesday from 12:30 to about 1:30. We've got a little bit of time left. If anyone has a chart request, I'd love to see what you are looking at. Like I said recently, my focus these last couple of weeks has been trading earnings, and particularly on selling volatility on names that I didn't expect to move a lot. So yesterday we had a trade on Disney, and you can see Disney's down about 4%. However, I had an options play that was basically taking advantage of about a 6% volatility. So it's holding up pretty well for us. Now, it is getting pretty close to where I would want to close it out if it doesn't bounce here. So if it doesn't bounce from here into the close today, then I might end up closing that trade and taking maybe a 50% profit, which is very similar to what we did on SBUX last week, which is I was expecting it to stay within the range, and it did so, but it came kind of close to what our edge was on our play. So we ended up taking about half profit instead of the max amount, but it also worked out pretty well for us. And we had a nice full trade on Netflix as well. We were expecting Netflix to stay range bound off of its earnings report, and it did so, and gave us a full profit on that. So, we've hit basically 100% on the earnings trades that I've recommended in my Patreon page, and have done a good job of being able to find other ways of manufacturing profits while we wait for the market to stabilize and give us a better trade environment. While the market's been chopping around, like I said, I've just been focused on earnings trades, taking advantage of increased volatility because the market has been kind of dropping back, and taking advantage of earnings plays that I didn't think were going to move as much as the earnings were pricing in. And so far we've done okay with that, and that's what I've been focused on. But like I said, I have time here. If you guys have a chart request, feel free to put it in. If not, there's really not much else I have left to talk about. So, hopefully over the next week or two, I will find more swing trade opportunities that I want to get involved in. I think one area that you guys could look at, by the way, is a lot of these earnings names. After they report earnings, they come down, whether it's a good earnings or a bad report. But particularly I find when I see a bad report on a stock that I think is pretty strong, a lot of times they give you something like Netflix. Now, Netflix bounced a little too quickly for us to switch to a long play. But a lot of times with these stocks is once they have their earnings report, there's no more uncertainty in the way, and you can start to trade them a little bit more clearly. And as you can see, Netflix had a very strong move off of a support level. Now it broke right through what I was anticipating. I was hoping for a little bit more chop before it broke out, but once it did break out, it had a nice little bull flag, and then the follow through that, which has occurred over the last 2 or 3 days, which has been a very nice move. Again, I didn't trade this, but just pointing out that if you aren't sure what to trade, sometimes looking at these post earnings names, you could find that they set up for moves once a lot of that uncertainty and pressure that was built up waiting for earnings is relieved. A lot of times you can get a move that goes through that. Ray, you have a couple you want me to take a look at? Good to see you in here, Ray. And good, by the way, anyone else that's in here, thank you for attending. I don't get to see what your names are. It just says viewers. But if you're in here, thanks for attending, and hopefully you like what you see. Well, Ray, this is pretty nice. I hope you already bought. Obviously, today is a very nice breakout. And the problem is, if you didn't buy this now, you can't really chase the action right now. Now, that being said, there is a lot of, obviously potential reward here is all the way up to the gap fill at 1081, and this is at $4 right now. This is a very nice breakout, a decent amount of volume on it. We had a beautiful cup and handle and a breakout through it. This looks good. There's nothing I could see. Yeah, this is awesome. Very nice breakout. Hopefully you get another big green candle tomorrow, and then maybe it bull flags and then continues to try to make its way to the gap. Now, the gap is very far away. I don't expect the gap fill anytime soon, but there is definitely more room to the upside on this. I think $5 is typically a level. It's a nice round number that a lot of people wait for to sell, and there's usually a lot of potential resistance up around 5. But I think overall this is doing really well, and this is a nice winner. Good job on this, and yeah, hopefully it continues for you. This is beautiful. I wish I would have seen this one. This is nice. I'm actually going to add this to my watch list. I like it when I see this, Ray. Instead of you kind of messing with these triple leverage funds, I like when you find stocks like this. That's a nice one. Good job. So this is a Toronto Stock Exchange, right? I'm not getting this. Okay. For me, it just shows I could just do it like this. All right. So you're in. So this is a platinum one. It's doing. As far as precious metals are concerned, it's not doing too shabby. It has potential resistance coming up. It's doing something very similar to gold and silver, and this happens a lot with these metals where they have a nice breakout, but then when they consolidate, they have these really wide ranges of consolidation. This one I think is doing good. A lot of volume coming in, which is really nice. Again, this is a cheaper stock. But a lot of times what you want to see in these is you want to see the volume, you want to see the accumulation. This one's great also. It had a nice pullback to the $2 range is good support. You can see it was support resistance, and it turned into some support here. And yeah, you can hold this one too. This is looking good. Not as strong as the other one. I'm not sure. It's only 5 viewers, Ray. I'm not sure why anyone else won't chat. Some people don't like they like to look, they want to watch. They don't really want to chat, which is fine. But yeah, there's only 5 people, so it's not like there's that many people on here. But yeah, some people just want to watch, which is fine. Like I said, it's nice, just having people here is fine. So good job on this, Ray. I think that this is holding up well, and I think with the strong volatility coming in, it's holding up fine. Don't worry about it, Ray. You're the only one offering. You're the only looking for stocks. So I don't know if I can get this one. ERF. Oh, ERF. Enter plus. We'll look at on the Canadian one now. All right. So this one's not looking so hot. Go figure. Oil, right? So this is what we were talking about before. Oil is really struggling, and this one, yeah, it's gonna have the bounce just like what other oil names, but I'm not as excited about this because, like I said, when I was talking about oil and oil names in particular, there's so much selling pressure on oil right now that even these oil names, when they do finally get a bounce, I think more than anything it's just a relief bounce, and you can see it's a very strong trend to the downside. And I think the only positive I could really say for this is not a positive at all, and that is that, oh, it's not even really accelerating to the downside yet, is it? No, yeah, so not even that. I was going to say maybe it's accelerating down, but no, you can see the only positive is that it's at the bottom of this channel. But this is in a very clear downtrend, and even when it bounces, it's going to bounce into some serious resistance, and it might make its way back up to the $8 range, the top of this. But from there, it should find some real strong resistance. So, of the three, this is the one I like the least, Ray. Now, that being said, it does look like it's ready for a relief bounce. But the problem with these is the opposite of what I was saying before about shorting. Is there's so much selling pressure on this that even when you get a bounce, sometimes it's difficult for the bounce to be sustained because you have so much selling pressure and you have so many underwater buyers that are just happy to get out at break even or at less of a loss. So you're going to have some selling pressure at 7, and then you're going to have some really strong selling pressure around 775, 780, and then again even more selling pressure in the $8 range. So this one not quite as nice as the other two. I think the other two are pretty nice long-term plays. Like you could just hold them longer. This one, I think, if you get a bounce, you should be pretty quick about taking profits, or at the very least, be pretty wary about protecting whatever profit you get if it does bounce. And if it doesn't bounce, don't hold on to this. Just stop out and just admit you were wrong on it. Okay. All right. Well, that covers your chart requests. Again, Ray, don't feel bad about asking for charts. Anyone else, by the way, if you're in here and you feel bad about asking, or you're kind of shy about it, this is when you guys ask about charts. This is good. I prefer this. It gives us more things to talk about. Sometimes it gives me stocks that I could put on my watch list that I want to watch, and it helps foster more conversation and better view of what's going on underneath the surface of the market. So I appreciate the participation, and I appreciate the attendance for those of you that are watching but don't want to give me a chart to look at. I think that kind of covers it for today. Like I said, if you have a chart request and you don't want to ask in a public forum, you can always ask me at Twitter, just StockDarts at Twitter, or you can visit us on our Discord chat. I don't know if any of you guys use Discord, but if you do, you can always visit me on there. Let me see if I can get an invite link here. Alright, so you can always visit me on there, and you can ask me there, and I'll be more than happy to give you a chart on there as well. And then finally, if anything, you can just email me, stockdarts@gmail, and I'll help you out there as well. I know some people don't want to ask in public or embarrassed about a question. So if you have a question or even something that's more in depth that you don't want covered on here, just ask me on there, and I'll be more than happy to help you guys out. Other than that, like I said, we meet every Wednesday from 12:30 to 1:30, or you could find me on patreon.com/stockdarts. You can see my trade ideas on there. Other than that, have a good rest of today, and we'll meet again next Wednesday.